Hey guys, so first of all, let me start with a big thank you to you guys. We did a video on dividend investing, ruffled a few feathers intentionally, just joking. But in that video, we mentioned right at the end that if the video gets 200 likes, you will get another video about dividend stocks. Now, these are our top 5 dividend stocks that we're going to talk about. Now, top 5 doesn't mean that we own them, okay? It just means that we think that there's something that you can look at personally for your own dividend stock portfolio, right?
Yeah.
You may or may not have heard of these names. So if you haven't, this video is for you. And if you have, maybe we can add some insights into these companies.
Yeah.
So here's how we actually look and sort of filter out these companies.
Yeah. So this is just a few fun facts from the age. Roughly about 50% of the entire listed company in Bursa Malaysia actually paid dividends. And then there's half of it, which is half of the, which is about 264 companies actually paid, will continue to pay in financial year 2024. And 67 of these stocks have 5% forward yield, which is roughly on par with EPF rate. And 32% will have more than 6%, which is more than EPF, which is very impressive. And out of the 32, right, we shortlist only 5, but actually there's more than 10 or 15, but we decided to just share 5. Maybe if you're in FIRL Pro, then you know more.
Yeah, so what we did was basically for the first few steps, we did a quantitative screen, right? So it's just 50% of the companies that pay dividends, then 264, blah, blah, blah. But then I think the short list for the 5 stocks was a more qualitative one, right? It's not numbers based, it's more qualitative, right? So the first one is Hong Leong Industries. We can see that over time, the dividend yield has actually increased.
Yes.
By 2014, you're looking at close to 4.9%. Today, 5.5% is the norm, and it's basically EPF. It looks very similar to EPF.
Yeah. Actually, it's around 6% here. Yeah, that's why hovering around here. And if you notice, the share price also went up. Even though the share price like increased, right, their yield still maintained at 5%. So this tells you that if you invested here, right, your dividend yield shouldn't be like 5%. It should be maybe like even more than that.
Yeah.
Because you are enjoying both capital appreciation and also the high dividend yield.
Right. So I just want to check the share price. That means here you're calculating every year that it grew by how much, is it?
This one is basically based on their dividend yield per year during that particular years of that share price.
So this is the red one,
yeah,
right?
the red one is
so the share
yield.
price?
Yeah, the share price is the blue one, which is that year, what is the recorded share price. So I put the dividend divided by that current year share price. So basically, when it goes up, right, technically the yield also follow suit.
Right.
Yeah. So which means if you invested very early in 2014, right, your yield should be even higher. Your dividend yield should be higher.
I see. So this share price bar here, does it show the capital gains? No, right?
No, it doesn't show.
It shows,
but you can roughly see if you buy here, it's like roughly double the 2014 versus 2017 figure.
So yeah, that's on the payout ratio. So they are a profitable company, right? Not necessarily growing all the time, but generally profitable. Is backed by free cash flow. So this is something that is very important for us, right? Whenever we decide to invest in a company. Of course, why that is the case is probably not the video for this, or maybe you can touch a little bit on it. Why you think the net profit and the free cash flow tracks each other and has been growing and doing well.
Yeah.
And then when we look at the payout ratio, it's let me see
like around 40%.
Yeah, 40% of earnings.
Yeah. So generally, you want a company that actually pay out their dividends out from their free cash flow instead of the profit, because profit, it could not be like in the form of cash. Maybe it's just from invoices. So the only way that you can see whether they have like recurring money coming into the company is through their free cash flow. So if you notice, right, their profit is very lumpy, but their free cash flow is actually very steady growing up, which is a good sign, which means they have excess cash to actually reward the shareholders. And you want them to have excess cash to reward, not just using like maybe inside their bank balances, their cash in their bank balance, or even debt to reward you, right? So yeah, Hong Leong Industry is in our first spot over here.
But before that, right? Why is it? What about the business causes this free cash flow, you think?
Basically, they are in the motor distribution. side of thing, and also because Malaysia, there's a lot of people who rides motorbikes.
Yep.
They also like assemble parts also for motor. So their business is generally very steady.
Yeah, you can see in 5-10 years time, it's still going to be around.
Yeah,
right?
Exactly. So yeah, that's the good thing.
Although the risk here would be electric vehicles. The market may not be as vibrant as before. So that's something to take note of.
Okay, so this is your return on investment. Basically, if let's say you invested 1,000 ringgit in 2014, with the share price gain and dividend gain, you will actually make about 2x your money, or more than 2x, and this will give you a CAGR of about 12%.
Yeah, so every 6 years is doubling.
Yeah, very impressive.
Not too bad. Better than EPF, right? Okay, next we have Harrison. I think so. We go across the South China Sea to East Malaysia. So here you can see the share price also went up, but the dividend yield actually went up, which is quite crazy, right?
Yeah. So
that means the dividend grew faster than the share price, the dividend growth.
Yeah, exactly. You can say that also. Which also means basically business is doing very well for Harrison.
Yeah. So we'll talk about qualitative later on, but sorry. So we can look at the numbers, right?
Yeah.
So yeah, net profit grows like a lot. So no surprise, the share price will have grown.
Yeah.
Payout is actually dropped a bit. So wait, so it's so crazy. So they actually, the dividend growth actually grew higher than the share price, but the payout dropped. That means they are accumulating a lot of cash as well.
Yes.
The cash balance will have grown massively, right?
Yep. But the thing about Harrison is that their business model requires them to pay out more in terms of receivables and also in terms of their payables.
Okay.
We're going to touch on or maybe we can talk about their qualitatives now. Because they
just one. I think every company will just talk about one thing that causes us to have them inside this top 5.
Yeah, okay. So their business is very steady because it follows the Malaysia GDP. Why? They are in the distribution industry. Basically, they distribute fast-moving consumer goods, your industrial goods, your pharmaceutical, basically every single thing that they have in Malaysia, they will distribute it. And they are located in Sabah. So basically, distribution business, you need to buy the product from your principal or from the brand owner. And usually you buy it at a lower cost as compared to the retail. And then when they sell it to the retail, they'll sell mark it up a little bit. Yeah, and earn a small margin. That's why
they're basically like a middleman.
Yeah, exactly. That's why you see their free cash flow is very lumpy. Because they have to, and also if you notice, their debt also is quite they're in a net debt position, is because they have to pay.
They need the short-term working capital, the short-term money to pay out.
Yes.
So just apologies, we missed an R on the
yeah. So, but if this is like the ticker symbol, then this is the correct one.
Oh, that's a ticker symbol.
Yeah,
okay. Wow.
Yeah.
Okay.
So
so 13% slightly better than Honor Industries. I think if you force me to buy one company versus the other, these two, my money's on Harrison because the threats to their business is not as obvious, right? But this is purely based on qualitative. We have not talked about the valuation, whether it's cheap or not. That's a separate question. But you can see here, grew at 13% over the past 10 odd years, which is 122% in terms of share price gain. Hello, investors. Are you tired of going through endless complex financial reports? Maybe you're sick of all the information overload? Want a faster, easier way to research stock investments? Well, we've got the solution for you. Introducing FIRL Pro. FIRL Pro is your go-to source for concise, easy to understand stock reports. We shortcut your research journey by 90%. Each report is crafted to be straightforward yet informative, taking no more than 15 minutes to read. That's right, just 15 minutes to unlock key insights about stock investments. The program works especially well if you are busy with work, family, and activities. The best part, it's totally risk-free because we offer a hassle-free money-back guarantee. If you're not satisfied after purchasing it, just email us here within 10 days of purchase for a full refund. No questions asked. Not sure about the program yet? No problem. You can check out our free sample reports available in the video description or comments below. It's a great way to experience the FIRL Pro advantage firsthand. Get informed with FIRL Pro. So next we have Uchi Technologies. I think of the 5, this is probably my personal favorite. You can see the dividend yield is crazy, right? It's closer to 7%.
Yeah.
But
and
yeah,
in 2023, it's like 14.3%.
yeah, there's probably a special, some sort of special dividend. Yeah, so Uchi Technologies, the qualitative is very straightforward, right? Coffee. That's it. There are some potential boosters for Uchi Technologies going forward into the future, which is China. So in fact, China has always been seen as a tea drinking culture, right? Uchi Technologies is a Taiwanese company, so it definitely potentially, right, could work with Chinese partners. But China is generally a tea drinking country, civilization, but over time, coffee has taken over a little bit, right? I know it's a bad company, but Luckin Coffee was a very big thing in China. So you can see the demand growing, and instead of being potentially disrupted, they are actually going out disrupting in a way other types of preferred drinks. And I don't know what's gonna disrupt coffee. I genuinely don't know. Nevertheless, they have a risk, which is that they only have one client, which is Yura. And I think like 90% of the sales come from them. And that's not going to be fun, right? If they decide to stop the relationship. But you can see, this is like one of the most perfect.
Yeah.
It's crazy.
Basically, they have cash. And also, I think generally Taiwanese run company in Malaysia, they like to pay dividends. That's why you see their payout
They don't like
ratio is
to
very
talk
high.
to you, but they will pay you dividends.
Yeah, that's at least they show their action more than what they
so this is probably, in terms of numbers, qualitative is one of the best. So ROI, 20% every year. I mean, just crazy. You think about it. I mean, that's Warren Buffett.
Just investing in one company.
Warren Buffett, right? So FPI, that's the next one. So FPI, the numbers look good, but I think the industry might be a bit more challenging, right? So
they are in the audio speaker industry, also related to some sort of like EMS, because they have to like box build, they have to assemble a lot of this stuff, their audio equipment. Yeah, basically, how often do you actually buy your audio speaker or whatnot? So that's the tough part about FPI lah. But if you look at their balance sheet and everything,
they're solid, rich, right? Like financially, one of the best out there.
Yes, everything is actually pretty good. I believe also, are they a Taiwanese run company? I think also, FPI also. So if you notice their payout ratio also, right now it has actually dropped a lot from 200% to now 50%, which means they're actually collecting more cash than they're paying out debt. Very good. And look at their ROI, it's actually the best, because every year you're going to be getting about 22.3% just by putting 1,000 ringgit in 2014. And then you just let it run for the next 10 years.
And this is after FPI has dropped in price quite a bit, right?
Yes.
If I'm not mistaken, in the past couple of years.
I think this one is before, because this is 2023.
2023, okay.
Yeah,
so,
probably before. I could be wrong. But but basically it's still a wonderful company.
Yeah, fantastic. Okay, last one, United Plantation. Very interesting. Obviously, I think in our views, when we look at palm oil companies, the best run palm oil company in Malaysia. Not the biggest, right? Not the one with the most tonnage exported or whatever, or harvested, but they are the best run. And you can see the dividend yield is just crazy. This is like, just on the yield alone is already outperforming EPF by such a big margin. Financially, it does look like an Uchi Tech as well, right? Payouts are north of 60%, 70, 80% sometimes. You're looking at free cash flow, very choppy, which is expected, right? Palm oil industry, ups and downs.
But actually, their free cash flow is actually very steady, considered steady as
compared to others. Yes,
as palm oil.
So for them, it's just up, but how much, right? Their free cash flow. For others, is up and down.
Yeah.
So we look at the debt. So now this is probably among all, and I could be wrong. Remind me if I'm wrong. The United Plantation has the most debt compared to the rest.
No, they have the most cash.
Oh, sorry, this is net cash. Right, sorry. Yeah. So now this is rare because, it's a capex intensive industry, right? Palm oil. And you've looked at palm oil, let's say out of 10 companies, how many are in net debt position?
Oh, that's actually plenty.
Let's say out of 10, right? Just
probably maybe like 60 to 70% is net debt.
So out of 10, 6 to 7 are net debt. But in this case, it's net cash, right? For United Plantation side, right? Palm oil.
The reason also is because when you just started out a palm oil business, right? Your trees, you need to like grow your trees. So your initial capex is first you need to buy the land, and then you need to buy the seeds, and then you need to hire people to actually like nurture this tree. So your upfront capex is huge. But then you have to wait like 10, 20 years later, then only maybe you start to see some sort of like cash flow coming in, and then that can pare down.
Exactly.
So it's a very long business, but then after 10 years, then you start to see more money coming in. That's why you can look at United Plantations. Generally, they has actually started in 1990. During the 90s already they started. So their debt actually paid out very fast already, very quickly, and that's why they are reaping their soul. Yeah. So very great. And you look at their ROI also, it's also
it's the weakest of all, right? I think I could be wrong, this is just a theory, but I think it could be the fact that the valuations are already higher on average.
Actually, I think it's because it is not that attractive to investors back at that time, from 2014 to 2023, because they only have so much of these palm oil trees only, and basically they projected a growth that is very stagnant to maybe it's still growing, but it's like a very slow growing, so that it doesn't really capture a lot of attention. That's why you can see their share price gain only is like 18%.
That's right.
If you look at 2024, recently only there's more institutional investor poured money into United Plant, which is pretty funny.
So as a summary, I think my views is that, as far as business quality is concerned, the ones that you see below, Harrison's, United, and Luchitech, these are my top three personally, right? But I want to remind everybody that this is my favorites are purely based on the management and also the business environment that they are in, right? It doesn't mean that it's a good investment, right? It doesn't mean that it's not a good investment. It just means that there are other things you need to look at before you decide whether or not it's a good investment, namely valuations and opportunity cost. But these five has been, some of the best dividend companies in Malaysia. And as another reminder, whenever you're investing in dividend stocks, you don't just want to look at the dividend yield. I know we put this out here for you as a summary, but you really want to focus on where the company is heading, where the industry is heading, and whether or not they'll be around, and whether or not they'll be actually growing, and how much. That's the most important. Because I would gladly take a lower dividend yield company if it means that profits are going to grow more in 10 years versus a high dividend yield company, but it's going to be stagnant or it's going to decline over 10 years. I'm going to take a pass on that. But any thoughts on dividend investing?
No. So if you want to know more companies on how we actually like shortlist, right, you can actually check out our FIRL program.
So that's why we actually talk about valuations. Right. That's why we talk about, would we go into Uchitech right now? Us, just both of us. Would we go into FPI right now? That's where we discuss all these things. And how do we discuss them? We have a Telegram group, right, with other fund manager experts and all that, who are very willing to share their investment insights. And ultimately, all of this, plus the reports that we have in FIRL Pro, is geared towards you shortcutting your journey, right? All of us have only 24 hours in a day. You may not be like us, where we can do this full-time, or at least it's a main thing for us. And maybe you are also afraid that you can get some of this wrong because you don't spend enough time. And if you're in that position, then I suggest to give FIRL Pro a go. And if you're still on the fence, that's totally fine. Feel free to check out a free sample report that we have, so that we have 2 reports in there for you to look-see. And if it fits you, then fantastic. Now, guys, thank you so much as usual for watching and supporting our videos. And I hope you enjoyed the video, and see you in the next one. Bye-bye.